Welcome back. You're probably sick and tired of hearing me talk about IPOs, right? But you gotta hang in there because I have a couple more sessions left on IPOs. In this one, rather than focus on individual companies that have gone public, I want to talk about the process by which companies go public and changes that might be coming through the process. This should not come as a surprise. After all, in the last decade, we've seen companies, disruptive companies, come in and challenge the status quo in business after business. Whether it's Tesla with automobiles, or Uber with ride sharing, or Google and Facebook with advertising. So it's probably surprising that it's taken so long for these companies, these disruptive companies, to turn their attention to the process by which they're taken public. Now, I don't want to be mysterious. The way in which companies have gone public for decades now has followed a pretty standard path. You get a lead investment banker who puts together a banking syndicate, and that banking syndicate manages your public offering. We'll talk about that process, but it's been a remarkably stable process, both in terms of how it's structured and how much banks charge for the services they offer. In the aftermath of the WeWork fiasco, finally, people are starting to ask questions about the process, and I think it's a healthy discussion because the world and markets have changed, and it's surprising that the process itself has shown so little change. So let's talk a little bit about the existing process by which a company goes public. And here's what I'm going to do. I'm going to list the steps involved and how bankers have been involved in every step in the process. The process for going public, of course, starts with a private business deciding it needs to go public. We can talk about the forces that drive private companies to go public, but bankers are often involved in the process. In fact, in many cases, bankers might push private companies or nudge them towards going public. Now, once you decide to go public as a company, you got to go find an investment banker. And as I said, the sequence might be reversed. The investment banker might find you, but there is a lead investment banker who then generally puts together a syndicate of other bankers, brokers. So a group of financial service firms whose job it is to market your IPO. Now, the issuing company has to file a prospectus with the SEC. Now, of course, this document comes from the issuing company. It has to have all the requirements. And remember, prospectuses are as much legal documents as financial documents. So you got to meet that checklist. And here again, bankers can play a role because they've done this before. They've taken other companies public. For all you know, they have a prospectus team that can help you put your prospectus together to make sure that all the check boxes are met. The bankers then look at your company and set a preliminary price. Notice the word I said, they set a preliminary price. They don't value the company. Their job is to set a market clearing price. And that preliminary price might be based on what VCs paid most recently. It might be based on what bankers assess as what you're going to be compared to in the market. But there is a price that they set. Now, once that price is set, bankers then seek out potential investors. And the advantage you have with the banking syndicate is they should be able to reach out to their investor clientele and come up with a price that is okay. So bankers basically are most involved in the pricing process because they can test the price out and come back to you and say, hey, that price is too high. Investors are balking. They don't want to pay that price. There's a feedback loop that they use to come up with a better price. Then, of course, there's a roadshow where essentially it's a selling of the company, where the company managers and the bank go out to different parts of the world and convince investors that this is the company they should invest in. Then the banker, after that roadshow, sets a final offering price. Notice that the pricing process goes through sequences. There's an initial price, you test it out, you reset the price. The final price is set pretty close to the offering day. And the banker guarantees that price. That sounds like an incredible advantage, but we'll come and talk about why it might not be as big a benefit as it sounds. They guarantee the price. And then, of course, the stock opens for trading. If the stock opens for trading above the offering price, the banker is off the hook. If the stock opens for trading below the offering price, the banker's on the hook. He's got to come up with the offering price. And then it's also the banker's role in the aftermarket to provide support, both explicitly and implicitly. Explicitly by buying shares if there's selling pressure on your stock, and implicitly through puff pieces. Maybe that's too strong a word, but equity research that suggests your company is a good company. In other words, continued selling. So that's a conventional process, and you can see bankers are involved in pretty much every step in the process. Now, there is an alternative for companies that choose to go public, and they don't have to use bankers. It's called a direct listing. And in the direct listing, here's what you do. The company chooses to go, it still starts with the company choosing to go public. And they still might be helped by VCs, consultants, bankers along the way. The company files a prospectus, and again, they might have help in writing the prospectus, but perhaps not from bankers. And that prospectus contains all the checkbox information in addition to a story for the company and its prospects. The company managers, again with a little help, do a roadshow. And here's the biggest difference. There is no offering price set. The stock just opens for trading. There's a market clearing price. The market sets the price, so there is no starting price. And if there's a starting price, it's more of guidance than anything else. The market sets a price. A direct listing versus the status quo. So let's talk about why bankers, after all, bankers are very heavily involved, what they will make as the case for the status quo. Bankers will argue that they bring multiple benefits to the game, advantages that help issuing companies. The first is they argue that they're good at timing IPOs, that there's a good window for IPOs to go out. And from looking at it from the outside, that seems to be true, right? IPOs are hot markets and cold markets. You want to go public in a hot market. And bankers claim they know when the market is hot, when the timing window is open. Second, they claim the experience, and with good cause, that they've done this before. They can navigate the disclosure, the legal requirements for going public. Third is they claim they're master prices, not because they're some pricing geniuses, but because the access they have to investors, and they can test the price out. And they even argue that they can help you frame a story that will give you a higher price. Then comes the selling and marketing. They say, look, with a syndicate, you get much more selling in your going for you. You have sales teams from multiple banks working for you, and investor contacts that will allow you to sell your stock. And then they point to the guarantee. Look, we can guarantee a price we can offer you. We can set the offering price. And if we don't deliver on the price, we will make up the difference. And they also provide the benefit of aftermarket support. We talked about both implicitly and explicitly. Implicitly with equity research and selling, and explicitly by actually going in and providing price support by buying your shares. But there's a cost to all of these services, right? And it takes two forms. The first is the issuance cost. This is a direct cost. This is a percentage of the proceeds that you get on the offering day that has to go to the banker. And this number can actually be a pretty hefty number. For smaller offerings, less than 100 million, they can be 7% of your. So if you raise 10 million on that offering day, 7% of that, $700,000 will go to the banker. If it's between 100 to 500 million, the costs become lower for larger offerings, but not that much lower. Even if you have a $3, $4, $5 billion offering, notice the costs remain 3 or 3.5 or 4%, which is not a small amount. Notice also that there's very little change over time. In fact, I have a graph that I haven't shown here of what this cost looks like over the last 40 years. And I thank Jay Ritter, who actually is the person who's spent his life on IPOs, for keeping the data on IPOs on his site and allowing easy access to it. You go all the way back to 1980. It's remarkable how little the issuance cost seems to have changed over time. Maybe bigger issuers have a little more bargaining power now, but not that much more. But that's only a portion of the cost. You're saying, what's the other cost? Remember that guarantee bankers offer on the offering price? Well, there's a not surprising consequence to that guarantee. When you're guaranteeing a price, you're more likely to undershoot than overshoot, because the cost to you of overshooting are more substantial than the cost of undershooting. And when you look at the evidence, it kind of backs up this presumption. The average IPO is underpriced. How do we know? When you look at the opening trade on an IPO and compare to the offering price, you have a very, very direct measure of how much the underpricing is. This is a graph of how much IPOs have been underpriced between 2009 and 2019. Hundreds of IPOs, some small, some big. About 25% of IPOs were overpriced and 75% were underpriced. So already you can see the tilt towards underpricing. Right? Second, the median underpricing is about 15%. Now, Again, that's not that's a pretty substantial underpricing, and the collective loss in value. Because remember, when an IPO is underpriced, here's what happens: the preferred clientele who get these shares at the offering price collect the difference, and it's a difference that's really coming from the owners of the company, the current owners of the private company, the founders, the VCs. And that collective loss in value has, over the 10-year period, has been about $43 billion. There's a typo on this page that says about 25% of the IPOs were underpriced. It's really about 75% of the IPOs were underpriced. So let's talk about what's changed. I mean, this is the way IPOs have been done for decades. What's changed? I think the value added by bankers has dropped off, not necessarily because of something they've done. Some of it is their fault, but a lot of it is because of macro and market changes. The first is on timing. They've never had the skill to time markets. I mean, bankers might have claimed this, but the reality is no one can really time markets. That when you see hot IPO markets become cold markets, people are always surprised. I mean, think of how quickly the IPO market has just changed in 2019. At the start of the year, everybody was convinced this was going to be a hot IPO market. All you needed were a couple of bad IPOs and the entire mood has shifted. So there've never been timing skills but the recent, especially as a consequence of what you saw with WeWork, people are now much more willing to accept the presumption that bankers can't time this stuff. Second, when I talked about the WeWork, Uber, and Peloton IPOs, this was a few sessions ago, I talked about reading the prospectuses and feeling a sense of deja vu that I've read the same thing over and over again. Prospectuses, as I read them for these young companies, and there are a range of companies, automobile companies, food processing companies. I mean, it almost looks like they're written by one person. They use the same language. They frame themselves. It's almost like an app wrote the prospectus. And when prospectuses are written mechanically to meet check boxes, you really don't need banking help. An app could write it. That risk profile section for all of these companies, completely useless and written by an app probably. Should be, because it's that useless. Third, and this is, I think, where banking has dropped off the most. The biggest benefit bankers should bring to the game is that they're better at pricing these companies, especially for public market investors, than VCs are in companies themselves. And this is where I think banking's value added has dropped off, because they're making some horrifically bad mistakes. It's unfair to pick on WeWork. It's such a disaster. But I'm going to do it anyway because I think it kind of illustrates something about this process. This is actually a graph that I pulled off the Financial Times, where the writer actually had access to what the investment banks had priced WeWork at the time of its at the time of its public offering. So Morgan Stanley, for instance, had a range of between 43 and 104 billion for the pricing. That is an absurdly large range. So already you can see one of the problems here is they're trying to cover their rear ends. And Morgan Stanley, even with that big range, did not. Goldman Sachs estimated a value of 61 to 96 billion. And JP Morgan had a value of, they had a tighter range on the value, but they also estimated a value of in the mid 40s, 46 to 63 billion. Of course, as you know, the rest of the story, the VC pricing that preceded this public offering was the SoftBank VC pricing of 47 billion. Notice it almost frames the pricing for all of the investment banks. So first thing, it looks like investment banks are taking the VC pricing and building on top of it. Second, the actual pricing for WeWork imploded. My estimate for the value was 14 billion. And given that's a company in the knife edge, it might very well end up being a company worth nothing. Put differently, the question you have to ask is, how can all of these investment banks have been so horrifically wrong in the pricing? And I can think of three reasons. First is that these banks are mispricing these companies. They're using the wrong metrics and the wrong peer group. Remember, all these companies describe themselves as tech companies. So perhaps one of the explanations is that the bankers are just mispricing these companies. The second is that they're talking to the wrong people. Remember, I said one of the things that bankers can use is the feedback they get from the investors they speak to, that they test the price on. maybe they're talking to the wrong set of investors. People are most enthusiastic about these companies and not to a broader subset of investors. There's a third potential explanation, and I think this is the most likely one. Bankers are so eager to be part of these deals that they're telling companies what they want to hear. And guess what? WeWork wanted to hear a number that was a high number, and they were giving the high number. And then trying to deliver on that number in markets, it's a dangerously delusional game to play. But bankers are not pricing these companies very well. Since we're beating up bankers, let's keep going. That selling and marketing that I talked about, but first, remember that selling and marketing made a lot more sense 20 or 30 years ago when you had some unknown private company going public, and the bank then became the basis for giving that company a profile. They were able to reach out to investors. Hey, this company, you might have never heard of it. This is what it does. But one of the things that changed is many of the companies that are issuing companies now have higher profiles than the banks that take them public. I would wager that more people knew about Uber and what it did than know about Morgan Stanley or Goldman Sachs. That might be over, but I really think it's true. Issuing companies often now have higher profiles than the banks that take them public. Not all of them, but some of them. The second is bankers have lost credibility. And whether it's their fault or not, this is one of the consequences of 2008. Pre-2008, you got a call from Goldman Sachs. You assumed that they knew what they were doing. And unfortunately, I think 2008 has damaged the reputation of bankers as honest arbiters, and that's affecting their selling pitches. The second, that price guarantee, well, it's not worth very much. It's almost an empty guarantee, because if you're going to underprice an offering, of course you can deliver on the price. It's like hiring a realtor who guarantees you a price on your house that you're trying to sell, but doesn't tell you what price, and then proceeds to price your house at half the prices of the houses in the neighborhood, then come back to you and say, look, I delivered on my guarantee. Who cares? It's an empty guarantee. And finally, the aftermarket support is being undercut for two reasons. The first is when bankers were taking small companies public, which was the prototype 20, 30 years ago, delivering aftermarket support was not a big deal. You could step in and buy shares and keep the price afloat. But when you're taking a company like Uber public and the market cap is 40 or 50 or 60 billion, bankers don't have the capital to come in and support prices if markets turn negative on these stocks. These companies have become too big to support. And in the aftermarket, all of that hype that bankers provide in terms of sell-side equity research, the same loss of credibility that's affecting their selling pre-offering affects their credibility post-offering. Who really believes sell-side equity research anymore? So if you have an investment banker taking a company public and the equity research analyst for the investment banker says, look, buy the stock. Hey, most investors say, look, I'm not buying that stock. You have you have a conflict of interest. So that's always been true, but now it's kind of risen to the surface and might be overriding whatever benefits you can get from that implicit backing. I'm not suggesting all of the value added has gone away, but clearly the value added by bankers in the IPO process is much, much lower across the board than it used to be 10, 20, or 30 years ago. Which raises the question, if it's changed so much, how come the process by which companies go public has not changed more? I would point to three forces. The first is what I think is one of the strongest forces in corporate decision making, which is inertia. Companies do what they've done because that's what's always been done. So banks should be happy that inertia is such a strong part, because a lot of companies going public use the banker-led model because that's what's always been done. The second is fear. The fear that shunning bankers might create consequences. It might be an unfounded fear, but you don't want to find out that your fears were not unfounded. You're worrying that bankers might lead investors away or talk investors out of buying your stock, that equity research analysts might put sell recommendations. You become so convinced that equity research analysts can push your price higher, that buy recommendations are what will keep your stock afloat, that you're afraid of shunning bankers. The third is another aspect, which is psychological, which is when you do a direct listing and it doesn't go well, you as a CFO or CEO are held responsible. Whereas when you hire a banker and things don't go well, you've got somebody to blame. It's always nice to have somebody to blame. And for the same reason that companies hire consultants and bankers to do things they should be able to do themselves, private companies hire bankers to take them public. That way, if something goes wrong, they can blame the bankers. So now what? What I'd like to do is talk about what I think is coming. As some of you know, Bill Gurley, who is a leading venture capitalist, has already started the push towards direct listings, and it might or might not happen. So I'd like to frame what I think should be what issuing companies do, what investors should do, and what bankers should do in this new market that we're entering. For issuing companies, here's my advice. First, choose the IPO path that is right for you. For some smaller companies with low profiles that need to raise capital, and this is something I forgot to mention when I compared a traditional status quo public listing with a direct listing. In a traditional status quo public listing, and on the offering day, you can actually raise capital to cover future investment needs, which is a good thing if you're a young growth company. With a direct listing, you cannot actually raise capital because it's a sequencing problem. You first have to go public before you can raise capital. So you can't, you're saying that's a terrible disadvantage to have? Not necessarily. In fact, these same private companies, if they really wanted to raise capital, could have a pre-listing round from their own VCs who will supply them the capital. It'll cost them a lot less than underpricing their stock by 30%. Or wait till they go public and make a secondary offering months down the road. Of course, this means you have to be willing to wait for the capital. So if you're a smaller company, you have a low profile and therefore can be helped by bankers selling you to investors, and you have an immediate need for capital, by all means stay with the status quo. If you're a larger company, you have a profile where investors know what you do already, and you don't have an instantaneous need for capital. You can wait a few months, or your private investors are willing to supply you with capital. I think you should clearly think about direct listings. You have too much to lose by going the status quo route. If you decide to choose a banker because that's what's right for you, here's my follow-up advice. Remember that your interests don't align. What's good for you and what's good for the banker are not going to be the same thing. Be real about what bankers can do for you. Don't expect them to double the pricing of your company or do magical things for your company. And negotiate for the best deal for you. I mean, so bankers say we usually charge 5%. Your response should be, I don't care what you usually charge. Given the services I see you offering me, I'm willing to pay 4%. You're saying, why would they accept my terms? Remember, you have the alternative now of walking away and doing a direct listing. Use that to your advantage. And if you can, I would tie that issuing fee to what happens on the offering day. You know, when Zoom went public and its stock on its offering day jumped 80%, the CFO actually acted like this was a good thing. In fact, that CFO was trotted out by bankers as somebody who argues for bankers. He said, this is amazing. The stock price jumped 80%. How is that amazing? You left hundreds of millions of dollars on the table because of the mispricing. So if I were negotiating with a banker, I would tie the pricing, the underwriting fee to how much and if you underprice by 80%, I want that fee back. If you choose the direct listing path, remember that the market may not agree with you. Just because you have a market clearing price doesn't mean it's always going to be a high price. And that disagreement is something you have to get used to, because as a public company, this is a lifelong problem you're going to have, where what you think your company is worth and what the market thinks it's worth will always diverge in either direction. In both cases, whatever you decide to do, you need to work on your story, because you're selling a story and the banker shouldn't be writing the story. You should. Because why? Because you know your company, your business better than the banker can. And you have to check to make sure it's possible, it's plausible, it's probable. Remember the 3P test. But also remember that this is a story that should be big but should be deliverable. You will have to deliver on that story. So if you overreach on your issuing story, you're going to have trouble meeting expectations thereafter. So you've got to weigh those all in telling your story. What's the lesson for investors that's coming out of all of this? First, choose your game. I told you that there are two ways you can play the IPO game: the pricing game and the value game. IPOs, usually most people entering and play the pricing game. If you're playing the pricing game, play the pricing game. In the pricing game, you buy at a low price, sell at a higher price. What drives your pricing choices? Mood and momentum, charts, I don't care, whatever you need to use. If you're going to play the value game, play the value game. In which case, you're not looking at mood and momentum, you're trying to value these businesses. Second, keep the feedback loop open. One of the things I can guarantee you on, no matter whether you play the pricing or the value game, is you're going to be wrong. Why? Because the world changes around you. You cannot get stuck on your initial story. You got to be willing to kind of revisit that story if the facts change around you. Third, spread your bets. Remember the old value advice, just buy 4 or 5 great companies, hold them forever. That will never work if you're investing with IPOs. You're going to be wrong more often than you want to be. And in fact, you're going to be horribly wrong in some of these stocks. Your portfolio of companies is what's going to keep you afloat. And what's going to really give you high returns is those big winners. There's 2 or 3 IPOs that are big winners. So spread your bets and be okay being wrong. And stop whining about conspiracies. I'm sick and tired of investors, of traders, of IPOs complaining about how VCs took advantage of them, founders took advantage of them, bankers took advantage of them, as if somebody held a gun to your head and said, buy the stock. If you decide to play the game, recognize that there are all kinds of conflicts of interest at play. You can't expect the SEC or the government to be your protector. It's caveat emptor. You do your homework and accept the fact that sometimes things are not going to work out for you. Finally, the end game for bankers. I know this is not great news for bankers because this is a big source of fees, but you have to get real about what you bring to the IPO process. You're not providing any timing advice. Get rid of that. Your real role is pricing. My suggestion is you do it better, which means that when you're asked to price a company, you need to reach to a broad subsection of investors, and you need to be able to go back and tell the truth to private companies. Tell the truth in what sense? If the pricing they're expecting is too high, you need to be able to tell the truth, because that's what you're being paid for, is to come back with feedback from public markets. And if you don't do that, then what's the point? So speak your mind, tell the truth, and finally get out of the echo chamber. What I mean by this is increasingly I notice that all of the investment banks have San Francisco offices, and much of what happens in the IPO space seems to be coming out of their West Coast offices. You're saying, so what? Well, unfortunately, those West Coast offices, I think, the people who go there might start off as bankers, but sooner or later, if you hang out with venture capitalists, you have dinner with them, you live with them, you start thinking like a venture capitalist. I mean, the real role for bankers is bring me a public market face to the table. That's not going to happen if you're thinking like a venture capitalist. So I'm not suggesting you close down your San Francisco offices. That might not be a bad idea given the cost of real estate there, but I'm suggesting you need to get some distance between you and the private investors. I think that distance has been narrowed because of this. You start investing in private companies before they become public, so this distance that used to exist is no longer there, and I think it's making you less valuable as advisors. So I think change is coming, and I will be looking at these changes. It'll be slower than you'd think. So if you're expecting overnight that private companies are going to use the direct listing route, don't expect that. But I think change is coming, and it's going to come. It's going to come at a pace, especially with large IPOs. That doesn't make bankers happy, but it is what it is.